Just keep grinding. Friday night, so tired, but still gotta grind.
Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to end our week looking at cash flows with a look at the 3M company's cash flow statement. We're going to take a look at their actual statement, plus the supplemental disclosures about the statement in the footnotes, and the discussion of the cash flow statement in their management discussion analysis, or MD&A section. Let's get started. 3M statement of cash flows is on page 51 of their annual report. First thing I like to look at is this breakdown of operating, investing, and financing activities to see what kind of stage or life cycle the company is in. So 3M throws off about $5 billion of cash from operations every year. It's pretty steady. They have cash outflows from investing activities of about $2.6 billion every year, and they also have net financing cash outflows of about $2 billion, other than a blip in 2011. So this is sort of the classic mature company profile. You've got products that are essentially cash cows. They're just throwing off cash, things like Post-it notes and Scotch tape, things that we can't do without. They're still reinvesting a moderate amount back into the company, back into long-term assets, and we'll look at this more in a second. And they are net cash outflows for financing. So they don't have to borrow, they don't have to raise money to fund their operations or their investments anymore. Instead, their operations are able to fund all of their investing activities and still throw off some cash that they can use to pay off debt or repurchase equity or pay dividends. So just to get some more insight into this, one thing that's often good to look at is comparing depreciation to purchases of property, plant, and equipment. Again, it's very rough, but if you view depreciation as using up your fixed assets, capital expenditures obviously as acquiring new ones, it looks like 3M's at about replacement level. So they are investing a lot in new PP&E, but it's sort of replacing the things that they're using up. They do have, though, some active acquisitions, so about $1 billion or so in 2012. And then there's a lot of activity with marketable securities. So they bought about $5.5 billion of marketable securities, but then they sold or had those almost all mature within 2012. So I think what happens is 3M is throwing off a lot of cash. If they don't immediately have an acquisition in mind or immediately have purchase of property, plant, and equipment, they plow it into marketable securities and investments. And then when those opportunities to make an acquisition or buy PP&E come, they liquidate the marketable securities and use that to go out and make their acquisition. So it's almost like they're serving as their own bank by buying these marketable securities, holding their cash, getting some return, waiting until they can invest it. And then in the financing section, we see a lot of the financing cash outflow is purchase of treasury stock. That's probably for stock options. And then there's a big dividend that they pay to shareholders, which again is another example oftentimes of a mature company that if you don't have a full set of investments that you can plow your cash back into, you may as well just pay it back to your shareholders and let them reinvest it somewhere. I think you're ready to do these kinds of life cycle or growth analyses on your own. So here's what I want you to do. After the video's over, go on the internet, find a firm that you're interested in, take a look at their cash flow statement, and see what you can learn by looking at the company's operating, investing, and financing cash flows. Now let's dig into the operating section a bit more. So we start with net income. Ignore the non-controlling interest stuff for now and just view it as net income. Nice steady growth in net income, indicating that they are consistently able to price their products enough to cover the cost of running the business. And typical of a mature company, you have this steady profitability. That steady profitability turns into steady cash flows. So very mature, well-performing, humming along nicely company. One of the big discrepancies between net income and net cash from operations is depreciation and amortization. Now remember, that's not a source of cash, even though it looks like it here. Remember, depreciation reduces net income. It's non-cash, so we have to add it back to get to cash from operations. Fairly big number for 3M because it does a lot of manufacturing, and manufacturing companies tend to have high depreciation and amortization. Then we have a number of other non-cash expenses, so things like pensions, stock-based compensation. We have some deferred taxes and excess tax benefits. So first, the pension and post-retirement contributions, stock-based compensation. These are things we recognize as expenses now, which means they're part of net income. But the cash is either paid in the future, as is the case for pensions and post-retirement benefits, or the cash really isn't paid, as it is for stock-based compensation, although part of it is you're buying back treasury stock to use to satisfy options. But in any case, there's no cash flow this period for these expenses. And we'll talk more about the stock-based compensation later on. The pensions and post-retirements, that's beyond the scope of this course. You'll have to come and take my course at Wharton, my elective, to see more on pensions and post-retirements. The deferred taxes we'll obviously get to later in the class. So then we get to the section on changes in assets and liabilities. These are the changes in working capital. And what we see is the big chunk here are accounts receivable and inventory are negative. So let's think about what that means. Negative number on the operating cash flow under the indirect method means that these amounts must be going up on the balance sheet. Accounts receivable goes up as a non-cash asset. To stay in balance, we have to subtract it on the cash flow statement. And yes, even though you can't see it, I am doing up and down arrows with my hand. Inventories go up on the balance sheet. Non-cash asset going up, we have to subtract that on the cash flow statement. Accounts payable is also going up. Now remember, that's a liability, so if accounts payable, a liability increases, it's on the other side of the balance sheet equation, we have to increase it on the cash flow statement. So these could represent either good or bad news. Bad news scenario would be our customers are not paying us, we're having trouble selling our inventory, we're having to stretch our payables. But that's probably not the case here given the nice growth and profitability that's going on. And so a more likely story is it's still a growing company. So during the year, we're making a lot of credit sales at the end of the period. We're building inventories in anticipation of future sales. We are getting more raw materials at the end of the year in anticipation of production. And so based on other things I've seen, it probably is a good news scenario that this is representing growth in working capital rather than bad news where you can't collect receivables and you can't get rid of your inventories. So overall, from the face of the statement, it looks like a mature company that still has some growth potential. Now we're going to look at some other sections to try to get some additional information about what's going on with cash flows. And yes, while you're looking at those cash flow statements that you've downloaded from the internet, you should also take a close look at the operating section. Look at net income, look at cash from operations, and look at all the things that cause differences between the two to see what kind of items that you would have questions about or want to learn more about to understand. Stretch our payable.
Why did you come to this section? I forgot.
On the cash flow statement. So let's think about what that means. Later on, the pensions and post-retirement, or the cash really isn't paid as it is for stock-based compensation, although part of it is you're buying back treasury stock to use to satisfy options. But in any case, there's no cash flow this period for these expenses. And we'll talk more about the stock-based compensation later on. The pensions and post-retirement cash interest payments, and as we is different from its cash flows. Now I've jumped ahead to page 69, where we have footnote 6, which is supplemental cash flow information. So if you remember back to the first video of the week, I said that there has to be a disclosure of cash taxes paid and cash interest payments. And as we talked about in, I think, the second to last video, that disclosure is there. So if people want to remove cash interest and cash taxes from operating cash flow, they have the number. So in this footnote, we see the cash taxes and the cash interest. So if you want to start with the cash from operations on the cash flow statement, in terms of doing some kind of valuation to measure operating cash flow, but you don't want tax or interest in there, you can pull those numbers out using this disclosure. One last section to look at related to cash flows is in the management discussion and analysis, which is on page 36. Remember, this is the MD&A is the section where 3M management is supposed to provide their own narrative to profitability, that steady profitability. They are consistently net income. Ignore the non-controlling interest stuff for now and just view it as net income. Nice, start with net income. Ignore the non-controlling interest stuff for now and just view it as net income. Nice steady growth in net income, indicating that they are consistently able to price their products enough to cover the cost of running the business. And typical of a mature company, you have this steady profitability. That steady profitability turns into steady cash flows. So very mature, well-performing, humming along nicely company. One of the big discrepancies between net income and net cash from operations is depreciation and amortization. Now remember, that's not a source of cash, even though it looks like it here. Remember, depreciation reduces net income. It's non-cash, so we have to add it back to get to cash from operations. Fairly big number for 3M because it does a lot of manufacturing, and manufacturing companies tend to have high depreciation and amortization. Then we have a number of other non-cash expenses. So things like pensions, stock-based compensation, and we have some excess deferred taxes and excess tax benefits. So first, the pension and post-retirement contributions, stock-based compensation. These are things we recognize as expenses now, which means they're part of net income. But the cash is either paid in the future, as is the case for pensions and post-retirement benefits, or the cash really isn't paid, as it is for stock-based compensation, although part of it is you're buying back treasury stock to use to satisfy options. But in any case, there's no cash flow this period for these expenses. And we'll talk more about the stock-based compensation later on. The pensions and post-retirements, that's beyond the scope of this course. You'll have to come and take my course at Wharton, my elective, to see more on pensions and post-retirements. The deferred taxes we'll obviously get to later in the class. So then we get to the section on changes in assets and liabilities. These are the changes in working capital. And what we see is the big chunk here are accounts receivable and inventory are negative. So let's think about what that means. Negative number on the operating cash flow under the indirect method means that these amounts must be going up on the balance sheet. Accounts receivable goes up as a non-cash asset. To stay in balance, we have to subtract it on the cash flow statement. And yes, even though you can't see it, I am doing up and down arrows with my hand. Inventories go up on the balance sheet. Non-cash asset going up, we have to subtract that on the cash flow statement. Accounts payable is also going up. Now remember, that's a liability, so if accounts payable, a liability increases, it's on the other side of the balance sheet equation. We have to increase it on the cash flow statement. So these could represent either good or bad news. Bad news scenario would be our customers are not paying us, we're having trouble selling our inventory, we're having to stretch our payables. But that's probably not the case here given the nice growth and profitability that's going on. And so a more likely story is it's still a growing company. So during the year, we're making a lot of credit sales at the end of the period. We're building inventories in anticipation of future sales. We are getting more raw materials at the end of the year in anticipation of production. And so based on other things I've seen, it probably is a good news scenario that this is representing growth in working capital rather than bad news where you can't collect receivables and you can't get rid of your inventories. So overall, from the face of the statement, it looks like a mature company that still has some growth potential. Now we're going to look at some other sections to try to get some section and talk about what happened in terms of their cash flows during the year. The big reason for the year-on-year increase in cash flows is net income went up. They do note that accounts receivable, inventories, and payables increased by 312 compared to increases of 484 last year, but they really don't talk much about what happened with that. Then at the bottom of the page, they disclose free cash flow. And as I said a couple videos ago, this is a voluntary disclosure. Notice it's labeled as a non-GAAP measure. That means that there's no requirement by the SEC or the FASB to provide this measure, which also means there's no standardization. Companies can define this measure however they want, and when they do that, they have to alert investors and analysts that this is a non-GAAP measure, so it's not standardized. So remember, free cash flow is supposed to be operating cash flow minus investment in the future. So we've got net cash from operations from the cash flow statement as 3M's operating cash flow, and then they use purchase of PP&E as their measure of investment in the future, investing in new property, plant, and equipment, which gives them a pretty high free cash flow. And that's actually a pretty good definition. I've seen a lot worse. So there's a pretty good definition of free cash flow, but again, before you would use this number, you want to make sure you know what's in the definition and that you're comfortable with it. On the next page, we have cash from investing activities, and what they've done here is they've netted all the marketable securities action into a small number. So instead of showing on the face the $5 billion they bought and then the almost $5 billion they sold, they just show a net number. So it really highlights that the big drivers of cash outflows were purchase of PP&E and acquisitions. And they tell you the PP&E is expanding manufacturing capacity in key growth markets, especially international like China, Turkey, and Poland. And so we can see that they do still have growth opportunities, and a lot of those growth opportunities seem to be international. For acquisitions, they refer us to note 2. You can go there and look. I'm probably not going to jump ahead and look at that. And then finally, they talk about cash flows from financing activities. So remember, the big chunks here were proceeds from, purchase of treasury stock. And the treasury stock, they say, is for stock-based compensation. Now, we'll talk about this later in the course, but basically, stock-based compensation is where you award your employees either stock options or stock grants. You could either issue new stock to satisfy that, or what most companies do is they just buy back their own stock and then either sell it to employees or give it to employees under these stock-based ownership plan or compensation plans. And then the other big chunk here is dividends to stockholders. 3M has paid dividends since 1916.
Oh shit!
So we're almost on 100 years of dividends, and that's again just consistent with companies that are very very mature products, throwing off a lot of cash. One thing they tend to do is they start paying dividends. 3M started pretty early. I'm not sure it was posted notes in 1916. And the thing about dividends is they tend to be sticky. Once you start paying them, you always want to start paying. You always want to keep paying them. If you ever cut them, it would be viewed by the market as bad news. So that's where we find all of the cash flow information in the annual.
3M stock. Really? Oh. What's the dividend yield? Oh, 4%. don't think they move much. Holy, 1982. 5 years is practically didn't move. Well, dropped that 25%. Most of it is from this year. Oh boy.
Report, and that's going to wrap it up for our week on cash flow statements. Hey, I was going to say that. Well, this does wrap up our week-long look at the cash flow statement. I know it was difficult, and there were some parts that didn't probably make a lot of sense right off the bat, but the cash flow statement is a very important statement, and we're going to be seeing it again and again and again as we look at more advanced topics, and the more you see it, the more you'll get the hang of it. I'll see you next time.
Cool. Week 4. Honestly, I don't think I'm past. From operating, payments to suppliers, advertising, low-key investing is this one. This is investing. Cash flow investing. Depreciation should be operating. Acquire company. This would be investing in you get new business and new structure. Proceed from issuing stock. That sounds like financing. Purchase of inventory. Sounds like operating. Selling equipment is. Company has the cash flow from operation. Minus 30, minus 45. Cash from. So it's losing money. Losing money. And selling stuff. Financing. Probably startup. Because you get a lot of money from financing stuff. I think it could be from IPOs, or it could be from a mortgage. Whereas still haven't quite profitable yet. It's like most of the startups, unfortunately. Cash from investing activities. This one, probably like buying equipment, I guess. Company bought 1 million building and 500,300 cash down payment. Use a new mortgage to pay the balance. What's the investing cash flow? Cash flow investing. Just minus 1 million. Doesn't matter if it's the land or what. No, the building is still investing. Which of the following would be shown as a positive number in both bracket section of the SCF? What's SCF? Under the indirect method. Indirect method, positive number. depreciation is on the right. It's on the asset, so it's minus proceeds from a mortgage. This one is positive. Gain on. It's not operating. It's not operating, so it has to be operating and increasing. This one's investing, increasing income taxes payable. This one's low-key financing. I don't know this one. My guess is sale of unnecessary. So this one probably show up like cash. Depreciating on the building is that using up assets. Why would it? I don't think it would be positive. This one I really don't know. I'll guess this one. When his net income of $10 reaching $2 of depreciation expense. Accounts receivable was 20 at the beginning of the year and 25 at the end of the year. Accounts payable was 15 and 10 at the end of the year. Net income. So plus 2, so there's 12. Account receivable. 20 and then 5. So someone's owing us money, so plus 5, 17. 17, then we pay the inventory, so minus 10, so 7. 7 inventory was gone, so 2. Doesn't sound very right, but anyway. Company put together preliminary versions of its financial statement. Its net income was $300, depreciation was 80, and its cash flow from operation was 190. The accountant found an error in computing straight line depreciation expense. It should have been 70. What's the cash from operation? 30. So 380. Then cash flow from operation. What? That's a trick question. What does it subtract? So it would be 8. This. Or depreciation expense decreases. So this should be increased by 10, 200. The company sold PP&E for $200 cash. For the sale, the net book value of the PP&E of the financial statement was $240. So lost $40. It's not operating. It's investing. So the following transaction will result. Change of inventory on the SCF being a different number than the change in inventory in balance sheet. What SCF is? Statement of cash flow, I guess. This one I'm just guessing because this one would be hidden in the acquisition. Guessing. EBITDA. EBITDA. It is before interest, taxes, and depreciation. Minus. Internet expense. This is almost operating. Modernization. Guess it was minus 250. Yeah, no one made it. Okay, next week.
Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to start our look at ratio analysis. And it's a good point in the course to talk about ratio analysis because it'll help us review some of the material that we've covered so far. After all, there's not a lot to computing ratios. It's just dividing one number by another. The real challenge is to try to understand what the ratios are telling us. And to do so, we need to reverse engineer the financial statements. We need to think about what underlying transactions must have happened to make the financial statements and the ratios change in the way that they change. In other words, the ratios help us identify parts of the business that are changing, where we need to go in and understand better what's going on with the company. In this video, we'll talk about some tips for using and misusing ratios. And we'll also talk about something called a DuPont analysis, which is a common ratio analysis technique for understanding changes in one of the most common ratios people look at, return on equity. Let's get started.
Oh boy, those return on investment.
Let's start by talking about how to use ratios. So ratios are going to be useful in assessing profitability, liquidity, and risk. They're going to highlight sources of competitive advantage for the company, so where the company is doing really well, and then red flag any potential trouble spots, so where the company is struggling. But to do this, we have to compare the ratios to a benchmark. There's no absolute benchmark. There's nothing like return on equity greater than 16% is great, below 16% is bad. Instead, you have to compare the company to the same company across time. We call this a time series analysis, and it helps us highlight trends for the firm. And we also have to compare the firm to other firms in the industry doing what we call a cross-sectional analysis. This is important because sometimes firm trends could really be driven by trends in the economy or the industry. So to figure out whether it's the company that's doing something well or it's just an industry-wide phenomenon, we have to look at the firm compared to its industry or its competitors. Ratios are contextual. There's no such thing as a ratio being good news or bad news on its own. The key is to try to figure out what activity drove the ratio to change and then decide whether that activity is good news or bad news for the company. And we'll talk about a number of examples of this as we go through the videos. And finally, the key is that ratio analysis does not provide answers, but instead it's going to help you ask much better questions.
My sister once told me that ratios provide all of the answers. She is a long-short hedge fund guru in Hong Kong. What are your qualifications?
Well, I'm not a long-short hedge fund guru. And I guess there's the old saying that those that can't do, teach, but I have looked at a lot of financial statements in my time. And I'm pretty confident in my claim that ratios provide an excellent diagnostic tool to help you figure out what areas of the financial statements you need to look into further, but they're rarely going to provide you all the answers. Now let's talk about how to misuse ratios. Not that I recommend that, I just recommend avoiding this problem. So one of the ways that people often misuse ratios is they don't realize that standard ratios actually can have multiple definitions. There's no standardization or gap for ratio definitions. Different sources will use different definitions. You want to always make sure you're using the same definition across time and across companies to make valid comparisons. Also, choosing the appropriate benchmark for comparison is important. Any major changes in the firm can distort a time series analysis. Differences in business strategy, capital structure, or business segments can make it hard to do a cross-sectional analysis. And then any differences in accounting methods, either across time or across companies, can make the comparisons difficult as well.
That preceding passage was a fair bit too abstract for me. Can you elucidate this further with some relevant concrete examples?
Yes, I can. So for major changes in the firm, imagine a software company goes out and acquires a hardware company so that they can integrate their software into the hardware. The problem is that this would make it a fundamentally different company. It would change the amount of manufacturing capacity and the amount of inventory, and the ratios wouldn't make sense anymore. All they would tell you is that the company's a different firm if you look over time. I'll talk about differences in business strategy, an example later in the video. As far as differences in accounting methods, one of the ones we talked about earlier in the course was some companies have brand names on their balance sheet if they acquired them externally in acquisitions, whereas other companies don't have them. That's a difference that would affect almost all the ratios that we look at, and you'd have to probably pull the brand name asset out of the one company in order to make meaningful cross-sectional comparisons between the two. The final thing to keep in mind is that ratios can be manipulated by managerial action. So if a company's managers think that investors and analysts are all focused on the same one ratio, like let's say an interest coverage ratio, then those managers have incentives to manipulate their accounting numbers to make that ratio look good. So always keep in mind that manipulation is a possibility. And more importantly, don't just focus on one ratio, but look at the whole body of ratios, because it's hard, and in fact impossible, to manipulate every single ratio to make it look good. Let's talk now about specific ratios, starting with return on equity. So, is a net income of $10 million good or bad?
Depends on how many spend to
I
get
could live
there.
with 10 million. Sounds like a great net income to me.
Yeah, if you were running a lemonade stand where your only assets were a table, a pitcher, some glasses, a bunch of lemonade, and maybe a cool Letterman's jacket, then 10 million in net income would be pretty sweet. But if you were running a
Legal
company with billions and
conductor
billions and
milk.
billions of dollars of assets, $10 million would be pretty meager for
And
net income.
injuries. So
So to
watching
assess whether
videos
$10
instead
million
of
in
typing.
net income is good or bad, we need to know how much investment was required to get that level of net income. So to assess whether a level of net income is good or bad, it depends on the level of investment required to get that net income, and that's what return on equity is going to tell us. Return on equity is defined as net income divided by average shareholders' equity. The numerator represents how much return the company generated for its shareholders during the year based on accrual accounting. So that's the net income number that we've generated through the course. The denominator represents the shareholders' investment in the company. Now, one of the problems we run into is net income happens over a period of time, whereas stockholders' equity is at a point in time. So we have to take an average of the beginning and ending balance of shareholder equity to approximate its level during the period we were generating the net income.
That's such a
This
poor
ROE measure
approximation.
measures a return on investment, and it's something that should increase with the risk of the company. For example, I could take $1 and put it in a savings account with a bank, and I'd get roughly 1 cent of interest, so my return on investment would be 1 cent. If I'm going to take that same dollar and invest it in a company, I'm taking much more risk, and so I should get much higher return. I should get an ROE much higher than 1%. So ROE is a great starting point because you compare across all of your investments, and hopefully the ROE is high enough to compensate you for the risk that you're taking investing in the company. Now we're going to divide ROE into two drivers to figure out whether a company is getting high or low ROE due to operating performance or due to leverage. So the first driver of ROE is operating performance, which answers the question of how effectively do managers use the company's resources, in other words, their assets, to generate profits. The ratio that we look at here is return on assets, or ROA. ROA is defined as net income divided by average assets. So what it tells you is for each dollar of assets the manager has to play with, how much net income do they generate? The second driver is financial leverage. This answers the question, how much do the managers use debt to increase available assets for a given level of shareholder investment? Financial leverage is defined as average total assets divided by average stockholders' equity. So for each dollar of stockholders' equity, how much assets does the company have? Now, the only way that this can be greater than 1 is if the company also borrows money, takes on liabilities. So this is a measure of leverage in terms of it measures how much debt the company's taking on to buy more assets than it has in terms of dollars of equity. One note is that this leverage ratio is very different from the other leverage ratios that we're going to be talking about this week. It's going to work for what we're doing with ROE, but we're going to use other ratios when we want to measure other kinds of risk due to leverage.
Pardon me, my sister just texted me back that you need to delete the net income in ROA. Moreover, she said debt to equity is a better leverage ratio than your financial leverage.
You know, I agree with your sister on this one. We do need to de-lever net income for ROA, but we'll get to that later. For now, I want to keep it simple so that you can see the two drivers of ROE. And yes, there are better measures of leverage for assessing things like bankruptcy risk and long-term liquidity, and we'll also get to those later. But the financial leverage measure that we're looking at here is the right measure if we want to see how much of ROE, or return on equity, is driven by the company going out and borrowing money, company going out and levering up. Let me show you a picture to tie this together. So we start with return on equity, and that can be split up into two components: operating performance, which is return on assets, and the financial leverage component. And so you see in the equation, we have ROE equals net income over assets times assets over equity. The assets cancel, and we get ROE equals net income over equity. Let me do a quick example. So a company raises $100 from shareholders, borrows $100 from a bank to buy $200 of assets. Those assets are then used to generate $10 of net income. So ROE in this case would be 10%, $10 of net income divided by $100 from shareholders. ROA would be 5%, $10 of net income divided by 200 of assets, and leverage would be 2. $200 of assets divided by $100 of shareholders' equity. Multiplying it together, 5% ROA times a leverage of 2 gives you an ROE of 10%. And this highlights how these two components drive ROE. So let's say instead of buying $200 of assets with $100 of shareholders' equity, we bought $400 of assets. So we borrowed $300 from the bank, combined that with our $100 from shareholders to buy $400 of assets. Now our leverage is 4. If we can maintain the same ROA of 5%, our ROE would go up to 20%. Or let's say that we keep leverage at 2, but we find a way to operate the business more efficiently to get the performance or the ROA up to 10%. Then we'd have 10% ROA times a leverage of 2 would give us ROE of 20%. So either operating performance or leverage can get you to a high ROE.
I am completely and utterly flamboozled by your example. Did you not inform us mere seconds ago that one must utilize average balances?
Really sorry to flamboozle you, but I was trying to keep it simple. I was trying to do an example which clearly shows how these two factors, ROA and financial leverage, combine to drive ROE. And yes, if I was doing these ratios in practice, I would take the average of the beginning and the ending balance for both assets and for equity. Next, we're going to look more carefully at the return on assets component, which also can be separated into two drivers. The first driver is profitability. How much profit does the company earn on each dollar of sales? The ratio we're going to use here is return on sales, or ROS, which is defined as net income divided by sales. So what it's telling you is for each dollar of sales, how much net income do you generate? The other driver of return on assets is efficiency. This answers the question, how much sales does the company generate?
Why do we use average everywhere? It's a good question. It's actually really interesting. Average is kind of easy. It's really easy to calculate. And when you have normal distribution, average is very close to the median. It gives you the 50% on mid-range of the two things. That's why, and a lot of things are normally distributed. So there you go. They're trying to find a median. They're trying to find the 50%. What's like an average or median person?
Generate based on its available resources. The ratio here is called asset turnover, which is defined as sales divided by average total assets. So for each dollar of assets, how much in sales does the company generate? Now I'm going to go through an example of how to do this in a little bit, but first I have to deal with that complication that came up in the question earlier. So ideally,
I just thought of it like just now. It could be wrong. be very wrong. But I think it makes sense though. It's logical.
Return on assets would measure operating performance independent of the company's financing decisions. We want a measure of ROA that's not at all affected by financial leverage. The problem is the numerator of ROA, net income, includes interest expense. If you have more leverage, it means you have more debt. More debt means higher interest expense. Higher interest expense means lower net income. And so now your leverage is affecting your net income. So to remove the financing effects from ROA, we have to de-lever net income. So we're going to define ROA as de-levered net income divided by average assets, where de-levered net income is net income plus 1 minus t times interest expense, where t is the tax rate. So what we're doing is taking after-tax interest expense and adding it back to net income. Then when we use this de-levered net income as the numerator in ROA, we get a measure of operating performance that's not contaminated by the company's financing decisions.
Ideally, you could explain this 1 minus t stuff. And it would not hurt to explain what delever means, and why we add interest expense to delever.
Yeah, I know the formulas are a little bit abstract, so let's go through an example and see how this works. Here's a quick example to show why we need to de-lever net income to remove the effects of financing decisions. Let's say we have two companies, one that has no debt and one that has some debt. Both companies have the same pre-tax, pre-interest income, so their performance seems identical in an operating sense. Then the no debt company obviously has no interest expense, so their pre-tax income is $300. We take off taxes at 35%, and their net income is $195. For the company that has some debt, they have interest expense. So if they had $50 of interest expense, their pre-tax income would only be $250. We take off taxes, and their net income is only $162.5. So if we use net income in the numerator for ROA, then ROA is going to be affected by the fact that the some debt firm has some borrowing. Now, if you look in the last row, we're going to calculate de-levered net income. We don't have to do anything for the no debt firm because it has no interest expense. For the some debt firm, we take net income plus interest expense times 1 minus the tax rate, and we end up with de-levered net income of $195, which is identical to the de-levered net income for the no debt firm. So using de-levered net income in ROA gives us a measure of ROA that only measures operating performance. Now, when we use ROE, we do want the interest expense in there because ROE does want to reflect the effective financing. So we take the financing out of ROA, but we leave the financing in for ROE. Now I'm going to try to tie all of this together with something called the DuPont ratio analysis framework.
Hey, is this the same the point that makes the model airplane blue?
It is pronounced DuPont. It is named after Helios Ariane DuPont.
Thanks for the correct pronunciation there, Renee. But yes, this formula was developed by people that worked for the DuPont chemical company back in the 19th century. In 1914, DuPont bought a big stake in this startup company called General Motors, which eventually became the largest car company in the world. And when the DuPont management team started working with General Motors, they would use this formula a lot, so much so that the GM people would say, hey, give me the DuPont formula analysis. And that's where the formula got the name, and we've continued to use it since then. So anyway, we've seen that return on equity has two drivers, return on assets and financial leverage. And return on assets has two drivers, return on sales and asset turnover. So the DuPont formula is that ROE equals net income over sales, which is profitability, times sales over assets, which is efficiency, times assets over equity, which is leverage. And what this allows us to do is identify whether a company's advantage or disadvantage in their ROE is driven by their profitability, by their efficiency, or by their leverage.
May you elucidate this further with a relevant concrete example of how one might utilize this DuPont formula?
Yes, now I'm going to do an extended example of how to use the DuPont formula, which will also allow me to show you the importance of choosing firms that are using the same business strategy when you want to do a ratio analysis comparison. So I'm going to talk about the retail industry. There's a couple big segments within the retail industry. One segment would be discount retailers. So those are the stores that have Mart in their name and try to compete on low prices. And another segment are the high-end retailers, the ones that are located in the really expensive shopping districts. Let's start by talking about the discount end of the market, the Mart stores. So their strategy is very low profitability. They have a small markup over cost, and their strategy is to get you into the store with their low prices. So how do they get high ROE? By very high asset turnover. In other words, they generate a huge amount of sales for their investment in assets. How do they do that? Well, their assets are things like fairly simple stores that are not constructed from fancy materials. They're located in rural districts where the land is pretty inexpensive. And then when you go into the store, you don't see a lot of fancy schmancy displays. The merchandise is just sort of crammed in there. And they're really set up to try to maximize the volume of sales for their level of investment in assets. So if you were looking at a discount type store, you'd want to compare it to another company doing a discount strategy to see if the company is able to get a little bit extra profitability, even though it's low in absolute terms, or if they're able to get much higher asset turnover, either one of those would give them an ROE advantage over their competitor. On the opposite end of the spectrum, you have the high-end retailers. Now, what I've heard that these stores are like, and I don't think I've actually ever been in one because I order all my clothes over the internet, but what I've heard is that they're really nice stores. They're constructed of expensive materials, marbles, woods. They're located in very expensive real estate areas. The merchandise is not crammed in there. Very nice, elegant displays. Their asset turnover, the amount of sales they generate for their investment in assets, is fairly low. But when they make a sale, it's hugely profitable. They have very high markup over cost. So if you were looking at a high-end retailer, you'd want to compare it to another high-end retailer to see if they're able to squeeze out even higher markups, or if they're able to squeeze out a little bit more asset turnover, even though it's lower in absolute terms. So the DuPont formula allows you to look at these different drivers of ROE, and as long as you're comparing companies that are doing the same strategy,
right?
find out where a company's
Well, I
competitive
guess that
advantages or
averages out.
disadvantages lie in trying to execute their business model. Now that we have the basic framework down, what we're going to do in the next couple of videos is look at a case study of a company that had some real troubles in their business, but then they changed their strategy, had a nice turnaround, and now they're performing very well. So we'll use the DuPont analysis to figure out exactly what parts of their strategy really helped to kickstart their turnaround. I'll see you next time.
See you next video.
Cool. 10:30 as well. See you next video. Take care.